Imagine two people with the exact same financial starting point, $50,000 saved, making $55,000 a year. One decides to buy a rental property, while the other puts that same money into total stock market index funds. Both believe they have made the smarter choice. Both are actually wrong, because one forgot to count the hours and the other forgot to count the zeros. When you actually run the numbers over 20 years, the gap will completely shift your perspective. The real estate investor uses $50,000 as a 20% down payment on a $250,000 home. With a 30-year mortgage at 7% interest, the monthly payment comes out to about $1,330. Finding a tenant who pays $1,800 a month makes it look like there's a clean $470 in pure monthly profit on paper. On day one, this feels tangible, real, and incredibly smart. Meanwhile, the stock investor puts $50,000 straight into index funds with no leverage, no tenants, and no keys to worry about. They set up an automatic contribution of $300 a month and completely walk away. For the first few years, it feels like nothing is happening. There's no asset to point to from the car window, just a changing number on a screen. But feelings and math are completely different things. By year 3, the real estate investor faces the hidden math of landlording: property taxes, insurance, a $1,200 water heater replacement, a leaking roof repair, and a single month of vacancy rapidly destroy that projected cash flow. Suddenly, the actual net profit drops from $16,000 down to just a few thousand. This does not even account for the late-night phone calls or weekend showings. The stock investor, conversely, has spent 0 hours managing their money. At a 10% average annual return, their portfolio quietly climbs to $76,000. However, the real estate investor still holds one major advantage: leverage. Using the bank's money to control a larger asset means that when the property value appreciates by 3 to 4%, their net equity grows significantly faster than a non-leveraged asset. By year 10, the two strategies reach a fascinating crossroads. The real estate investor has built substantial equity, but they also took on hundreds of thousands of dollars in debt, concentrated all their wealth into a single zip code, and worked a part-time management job. The stock investor diversified across thousands of global companies and never lost a night of sleep watching compound interest slowly accelerate. At year 20, the final numbers emerge. Both portfolios sit in a similar ballpark of roughly $400,000 to $500,000, but the path to get there is completely different. One worked for their wealth, while the other waited for it. Real estate delivers powerful leverage and unmatched tax shelters like depreciation, but it requires a high investment of time, stress, and liquidity risk. Stocks demand absolute discipline to survive gut-wrenching market volatility, but they offer total freedom and liquidity. The real trap is picking either path based on a trend without calculating the real cost of your time and peace of mind.